Good afternoon. This is James with 77 Financial Group. You're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. Happy Saturday, everybody. We are back at it again. We've got a jam-packed filled episode today. I can't wait to talk to you guys. I'm going to keep it under 15 minutes, so bear with me if I'm moving quick. Guys, we're moving to YouTube. Not moving, we're adding YouTube, actually. So we're going to have a video component, which we'll still upload to Spotify. Apple doesn't have that yet, but Spotify and YouTube, we are growing. So please, if you're a listener here, which there are thousands of you, please go to YouTube, type in the search bar at the @ at 15 Minutes of Finance. All one word, you'll find us. You'll see our logo. You've seen it before. We don't have any content yet because we're realizing this is way harder than we thought it was. It's way harder than audio. So we are transitioning to trying to provide video for you guys because we wanna increase this value. And also it helps to be able to see our mannerisms and our faces and just get an idea of what we're saying. Because body language is just as important as words. Okay, here. This is what we're going to do today. I'm going to break down a very complex topic. We're going to go over the news. And then I'm sick and tired of headlines. I'm sick and tired of them. You got one person saying the market's going to bust. And then you have another one saying the market's going to 10,000 by 2030. So we're going to cover everything, different indicators that matter. Okay, quit listening to headlines and then making changes in your money. Okay, have a plan, stick to it, be aware, be flexible, but stop letting these analysts that get paid to write about things, they get paid to write sentiment articles, okay? They don't really know what they're talking about. You have to be your own analyst. You have to do your own research, or you got to pay someone you trust to do it. Okay. So with that said, the term of the day, guys, is Chinese wall. Now, this is one of the best kept secrets in the entire industry. Investment banks don't want you, the retail investor, or really anybody, to know what this is because it would create immense legal issues for them. So every investment bank, you can plug and play a name, pick one. Goldman Sachs, JP Morgan, any of them. They have a research arm and they have a investment arm, right? The investment arm, they buy and sell, obviously. That's what they do. The research side that's where these headlines come from. NVIDIA is going to go to the moon. NVIDIA is going to zero. Palantir's overbought. Palantir's the best company in the world. Those articles, those different headlines, that's what the research arm of these companies do. So now, ideally, in a perfect world, that wouldn't even happen. An investment company would not have a research arm and a buy and sell arm at the level that they're at, right? Why? Well, because the investment company, the investment side obviously is going to have insider information on any of these research articles because they work at the same business. And so the traders, the buy and sell side, have incentive to buy out the research side. Hey, I'll flip you an extra 10 grand if you can say NVIDIA is going to go down to zero, right? Then they can, when that happens, the retail investor, retail money gets out because they're scared. That lowers the shares of NVIDIA, and the investment banker side, now they get to jump in at a lower share price, knowing that they just manually and synthetically created a downdraft on these stocks, and they get to jump in on a great company for a lower price. And you, the retail investor, loses money and you're none the wiser. Okay, that happens all the time. Now, legally, there have been some changes to that because it's in the 80s and 90s, that was a really big deal. It's called Chinese wall. So the concept is, yeah, sure, Goldman Sachs, JP Morgan, these investment banks, you're allowed to have both sides of the industry. You're allowed to have that at one company. They just can't be on the same floor, right? So if you have a 10-floor building, maybe they have to be, one has to be on the 8th and the other has to be on the 4th. That is the only thing that's separating the person who writes about the stocks and the person who buys the stocks at a company like an investment bank. How ridiculous is that? Once I learned that, it changed the way I invest forever because they're all in on it. They're all in on it. I don't care what they say. Now, obviously, they have these Chinese walls, which is, I don't know why they call it that, but it's supposed to be this barrier for the buyers and sellers to not interact with the research analyst. It's just not true. I refuse to believe it. I've been a part of these giant companies before. You see everybody everywhere. You talk to everybody. There's no real barrier between them. There is no information barrier. I'm speaking from experience. Okay, so that is the term of the day, Chinese wall. All the headlines you read, they're all just trying to get you to make rash, quick decisions so that the other people at the firm can buy and sell as they want based upon the fear or the excitement of these headline movers. Okay, let's read the news real quick. We have a short news day because I want to talk about I want to talk more about these headlines and sentiment and whatnot. Stocks declined Friday as the market took a breather from a rally that has pushed major indexes to record high levels. The Dow Jones Industrial Average and S&P 500 fell 0.2% and 0.6% respectively, while tech-heavy NASDAQ Composite dropped 1.2%. The S&P 500 and the Dow closed at record highs on Thursday, while the NASDAQ finished just a few points away from a new high of its own. Despite the declines today, the major indexes all posted solid gains in August for the fourth consecutive month. Investors were focused early today on the release of the Personal Consumption Expenditures Report, which is the Federal Reserve's preferred measure of inflation. The data showed that prices rose 2.6% in the 12 months through July, which was unchanged from the month before and matched economists' estimates. The Fed has held its key rate steady through 2025 amid uncertainty about how tariffs will affect inflation, which continues to run above the Fed's target of 2%. Fed Chair Jerome Powell signaled last week, however, that the economic conditions could warrant a rate cut when the Fed's policy committee meets next month. Okay, I'm cutting this short just because realistically, all-time highs this week, and then we had a big drop-off. NVIDIA gave earnings. They had good earnings, and the stock still dropped a little bit, way less than people thought. They were expecting a swing of 11%, either direction, 11% up or 11% down. But in reality, it went down like 3%. So, which I want to talk about that, but I just can't get over these headlines and these analysts and all of their opinions. Guys, when I'm at work, we listen to CNBC a lot of the day. We just like having it on. You get to hear different people's opinions. Sometimes you learn about a company you weren't expecting. You're right. We want to hear what everybody in the industry is saying. So we have a good grasp of the news. And I can tell you, I want to tell you as emphatically as I can that headlines and articles lie all the time. The people on CNBC, these interviewers, these professionals, they're just like me. They lie. Okay. And what I mean by lie is they say things to be contrarian. They say things to be aggressive. They want you to look them up. They want you to have a visceral, violent reaction to the things they're saying. Now, that doesn't mean they're always wrong. It just means a lot of the time they are. Just like a lot of the time I'm wrong. It's not about being perfect because you can't be perfect. None of this stuff is guaranteed. With as much data as you can get, you will only ever get a guesstimate, a guess, a hypothesis. And that's okay. That's more than enough to make so much money you won't know what to do with it. All right? Now, every article, every headline, they almost always will say something extreme, and then 3 months later will say something in the exact opposite. It's like a giant pendulum swing. Okay, they have to make up for their aggressive moves to then make a conservative move, or for their negative news to make up with the positive news. So I was thinking of what value I could bring you guys today about what actually you should be paying attention to, especially if you have a grasp of economic indicators. There are 4 things economically that I think matter. And then there are 4 things stock market wise that I think matter. And I want to combine them quickly. We can't really go over all of them. Some of them are self-explanatory. But if you can get a grasp of these things, then news headlines and news articles become more of a value add instead of the value itself. Okay? I've never bought a stock because I saw an article, ever. Now, it's either solidified and impressed upon my current opinion, right? It's been like, oh, so-and-so also feels that Palantir is a great company, or so-and-so also thinks that United Health is a buy. That's the value add that I feel from analysts. But there are really only 8 things that I can think of right now without getting in the details. There's obviously way more But economically, there's four. Okay, it's inflation, interest rates, geopolitical events, and cabinet policies. Those are the four economic things. And the stock market indicators of a good rising economy or a bad slowing economy is earnings, acquisitions, margin efficiency, and demand/sentiment. If you can grasp those 8 things, you will invest better than 98% of everybody. That's professionals and individuals. All right. 95% of retail investors, which is almost all of our listeners, people who manage their own money, they don't beat the market. The bare minimum. Okay, being in the S&P 500, the bare minimum. They don't beat it. Why is that? It's because of something called loss aversion. And I'm sure I'll have this be a term of the day next week or another day. But loss aversion is the feeling, and it really is a science to it, that losses hurt twice as bad as any gains. All right? It hurts way bad to lose money than it does to make money. And because of that, these headlines, these articles about these indicators, they make people make rash decisions with their money. So if you can grasp these 4 things, and I'll explain them again here, we have economic indicators and stock market indicators. Now, with the economy, everybody gets this confused. Economy and stock market. They are not the same thing. The economy is the country itself and all of the trading, all of the buying and the selling and the moving and the merging and the dissolving of a country, the activity within it, that is the economy. And the stock market is simply a piece of the economy. All right. And the stock market is buying and selling of companies. And that's a very remedial, high level or low level, or is it high level? It's a very surface level way of looking at what the stock market is. But that's what I want you to know. They're very, very different. The economy is way bigger. The stock market is a piece of the economy. Now, okay, the economic indicators, inflation. All that is that prices go up, right? In theory, it's that prices rise, your dollar buys less things. Your dollar does not do as much, right? Jack in the Box tacos used to be 2 for $2.99. Now they're 2 for $2.99 if you buy a meal. Okay, so that would be inflation, a cause of inflation. Next, you have interest rates. There's 2 sides of the interest rates. It's either what you pay or it's what you get if you loan money. So interest rates, the Fed determines this, and I'm getting super into it, but the Fed is the U.S.'s central bank, which is just the bank of the country. A bunch of countries have these central banks. Ours is called the Federal Reserve. So the Fed dictates interest rates, meaning what does it cost to borrow something? And when those go down, it increases borrowing activity, borrowing habits. Thus, more money gets borrowed, more money gets flooded into the system, into the stock market, into the economy. Okay. And then geopolitical, obviously that's wars, all that type of stuff is geopolitical. And then cabinet policies is just who's the president at the time. For us, that really matters because that's every 4 years. Now, stock market, really, really easy. What are their earnings? Is the company growing with acquisitions? How efficiently do they make money? And then what is the sentiment? Is this company the next Microsoft? Does this company have a monopoly on the industry that it's in? All of those things are way more important than, this is a little morbid, but the United Health CEO was killed, right? I don't even know if I can say that on the podcast. Who knows? I'm going to give it a shot. Obviously, that's horrible news. That's called non-systematic risk, which means it's something that you can't prepare for, right? It's an operational risk. There's nothing you could really do. That just happened, right? The fundamentals of United Health have not changed. They're still a giant in the health insurance industry. They're still a giant in the actual medical provider services industry. They have an immense amount of revenue, an immense amount of cash. They're still efficient in making money. All of these things make that company elite and make that company great, right? Now, obviously, if that company, you could have moral qualms with the way health insurance works, for sure. But fundamentals of that company, still great. The stock's down 50% from where it was because of what happened, right? That kind of news, You need to be aware of those things, because guess what's going to happen to that stock? That stock's going to go right back up to where it was probably within 18 months. All right. That is how these non-systematic risks happen with the stock market, with individual companies. All right. That's what I want you guys to focus on. So economically, inflation, interest rates, geopolitical news, cabinet policies, stocks, stock market in general, earnings, acquisitions, how efficiently do they make money, and the demand and sentiment. Okay? Those are the things I want you guys to focus on. Come back to this episode when you read a really negative headline and think, is the company still great? And I want you to think of United Health, because it is. Right? And obviously, I'm not a big fan of United Health. Another company I don't like is Affirm. Affirm is also a company that I think has immoral business practices. But that's not to say you can't make money off of them. All right? Okay. And we'll talk about Affirm a little bit next week. I'm at 16 minutes, so I just broke the 15-minute barrier, guys. All right. That's it for today. As always, invest early, invest often. We'll see you next week.